All right. Hello, everybody. Welcome. We are going to get started today. So we are Monday, yeah, April 22nd. So welcome to Money Matters. In today's episode, we are going to talk about something that has recently come up. Now sort of been on the radar for a while, but it's actually coming up now where it's like, oh, this could really impact us. Okay, so we will talk about the proposed changes that are taking place in the capital gains inclusion tax. Okay, so just keep in mind that this is something that will definitely affect me as a real estate investor, and it will affect other real estate investors, whether or not you are an independent investor like myself or under a corporation. You will be affected hugely by this change. And so we'll talk about the calculations around how much that change is and how that's going to impact you. So, the outcomes of these calls are really to help fellow accredited investors make sound decisions about, what they've done in the past and what potentially is going to come up in the future with confidence. So we will talk about that. So my name is Hung Lu, and I am with Cash Property Inc. And so this, in the next 30 minutes, we'll do the analysis, and then we will answer one or two questions that's come through. All right. So before we get into the calculations on the capital gains, just a big shout out to the participants at the monthly mastermind. We had one last Friday, and so it was a good session on how to do market research, and there was some debate going on about what's included in the capitalization rate when we do our market research. And so thank you to everybody who attended. And if you would like to be invited to these masterminds, please reach out to me on the QR code, and we will make sure that you get invited to the sessions. Okay, so that is the shout out on the mastermind. Okay, so the topic that we're going to talk about now is the proposed change that's coming through on the capital gains. So I do have to say, okay, I'm not an accountant here. So, I've got a call in with my accountant to go through all of this stuff as well. So before you go and take the calculations that I'm doing or the advice that I have on here, please go and talk to your accountant, talk to other investors, and make sure that that what I'm saying is correct or not correct, and that whatever decisions you take away from this, make sure that it's right for you. Okay, so let me share with you my screen, and we will go into how this new capital gains is potentially going to affect you. Okay, so I built this out. So it's not perfect. It hasn't been validated yet because these changes, it's proposed. And so I'm just trying to get my head wrapped around this. And then, I'm going to be walking through this sheet with my accountant to make sure that it's right for me. So take it with a grain of salt right now that some of this information may be wrong. Okay, and then as well, I'm making the screen bigger here so that you can see it without squinting. And this is looking at it from the point of real estate. This capital gains inclusion rate change, it's just a proposal. It should take effect in June if it gets passed. My thinking is that it probably will get passed. Okay, so this inclusion rate doesn't just affect real estate investors. It affects small business owners or business owners, any sort of gains within a corporation. It also affects trusts. So it's not just real estate investors, but I'm only going to be looking at it from the point of small real estate investors. So individuals who have a couple of properties under their own name, maybe in a corporation, but mostly how does this affect, like the mom pops, small investors with a handful of properties, like maybe, two, three. This also applies to potentially like a summer vacation home. So if you've got, like your primary residence is in Southern Ontario, but then you've got, a cottage in Bancroft. Ontario, then this is going to affect you as well. Okay. So and this is across Canada. So it doesn't matter if it's in just Southern Ontario. Now, I'm running most of this based in the calculations are based in Ontario, but I also need to redo this for BC because I'm a resident of BC now. Okay, so take it with a grain of salt that some of this information may not be 100% applicable to you, but if you have like a second property, whether it's fully income or not, and then if you've got like a couple of rental properties, and it doesn't matter what province you're in, this is going to apply to you. Okay, so I've got in here, just trying to figure out, answering the question one, how is this capital gains inclusion rate change going to affect me? Okay, and one, based on that information of how it's going to affect me, do I need to do anything? Okay, so do I need to offload some of my properties or do I just sit on it and then figure out another strategy to go with that? So those are the two questions I'm going to try and answer with this calculation here. Okay, and because we're in April, we only have like, a couple of months to make a decision on what to do. And because real estate, it's not that liquid, meaning that, okay, if I'm going to sell a property, it's going to take me time to find a buyer and close on it, right? Like potentially the closing could be 30 to 60 days. And especially if it's a rental investment property, I've got tenants living in there. And so, if I'm selling it with assuming tenants, then, the closing time is going to be different than if I'm going to need to provide a property that's completely vacant. Okay. So all of this plays into, okay, well, do I need to do something now, right, to make sure that I meet the June 24th deadline? Okay, so I've got a placeholder here of 1.5 in capital gains. The minute you have $1 in capital gains, this is going to affect you. Okay, so I'm just putting in 1.5 million. I've got a question here saying, okay, does the 250K minimum apply to me? And in this case, it doesn't apply to me. So what this is if you get some sort of like an exemption, but it's not really an exemption because you're going to be taxed on that 250. So if your capital gains is less than 250, then you're going to be at a 50% inclusion rate instead of the new rate, which is the 66.67 rate here. Okay, so in my case, this lower capital gains inclusion rate is not going to apply, and it's not going to apply to you as well, because it's usually, as an investor, we're not going to be allowed to use this 250. Okay, so that means under the okay, so let's go into what the old rates would have done. Okay, so currently right now we're at a 50% inclusion rate. And so what that means is if I had a capital gains of 1.5 million, my amount, the amount that I would have to include in my tax income, my taxable income line in my tax package is 750,000. Okay, so then that's the amount that would increase my taxable income by 750, which is huge, which will put me in the highest tax bracket. Okay, so right now in Ontario, the tax bracket, the marginal tax rate is 26.8. So that means I would be paying about $200,000 in taxes to the government. Okay, so this is what is the current situation right now. So I would still have to pay $200,000 if I was to sell a property and recognize 1.5 million in gains. The new proposal that's coming through is changing that 50% to 66.67%. So that means instead of including 750 in my taxable income, I would be including just over $1 million. Okay, so this is a formula in here saying, okay, well, what's the capital gains and do I get the first 250 at 50%, and which is a no. So that automatically calculates the $1 million. that I would have to put in my taxable income line to say, okay, in this year, I'm recognizing $1 million in capital gains. And so that's how much I would have to pay taxes on based on my marginal tax rate, which in Ontario, they're also proposing to increase that to 35.69. So there's two changes that are happening. One is the increase of the inclusion rate from 50 to 66.7. And then the second is the increasing of the marginal tax rate for Ontario. So this is Ontario, but you can find this for different provinces. So what they're doing is they're increasing it from 26.8 to 35.69. Okay, so it's like a double increase. Okay, so what I wanted to know was, okay, what does that actually mean? Okay, so what it means is instead of paying $200,000 in taxes to the government for this 1.5 million capital gains, I am now going to be paying $356,000. That's huge. Okay, that's $155,000 in 1 year to like have to pay that out. Okay, now as an investor, I can so if I'm selling this property, I can do a vendor take back and provide somebody a vendor take back and delay this capital gains. Okay, so it's not like ignoring it or not ever having to pay this. Is delaying this a little bit. So potentially doing a vendor take back, which would be great because then I can do up to 5 years and delaying this. So that vendor take back is a completely different strategy, but I'm going to tack that on here just so that you know that there's ways to sort of delay this. Okay, so that would be one. So the difference between the old taxation versus the new one is $155,000. Okay, so that's pretty good. Like it's pretty big. So it's not good. It's not good at all. Okay, so now one of the things I was thinking was, so if I didn't sell now, right? Because if I was to be like, okay, well, I don't want to have to pay this $155,000 difference, I would actually go and sell the properties now. Okay, but if I sold it, I would have this $200,000 capital gains. So instead of selling it, if I had $200,000 available and I took that money and invested it, does that make sense to even calculate it, right? So I calculated it out because I just wanted to see, okay, well, how much does that translate to in years, right? So for me to have to sell it today and pay that out, instead of selling it, what if I was to take that money, invest it, and utilize it so that it would generate enough profits so that it would cover my future capital gains? Okay, so what I did was I ran this table here saying, okay, so instead of paying 200,000 out to the government now, I'm going to take that money and invest it in some way. Okay, I'm going to invest it in something at a 10% return year over year. Like it has to be compounding, it has to stay in there. Okay, so basically I'm calculating this out, and this is a normal compounding interest table. Okay, and so what I'm doing is I'm calculating the gain that I'm seeing year over year. So at what point, okay, would I actually see that $155,000 difference between what I would have to pay in the future for capital gains at this new inclusion rate? Okay, so if you look here, it's this 153,000, which is in year 8. So basically what that tells me is that in order for me to make it worthwhile not to sell, so I keep the property, and somehow I just have to make sure that I get a 10% return year over year over year, I need to hold on to this property for another 8 years minimum. Okay, if I sell this property before 8 years, then it makes sense to sell now and then not worry about a 10% return. Okay, if I'm pretty confident that I'm going to hold on to this property, and this property is making more than 10% return a year, then it makes sense to hold on to the property, because I'm going to make way more than the $155,000 that in difference on that capital gains. Okay, that's what this means to me. So, you know, some of my properties in Toronto, I'm seeing way more than a 10% return. Like I'm seeing an upwards of 15% year over year. So which means if I just hold on to my property and I do nothing for, let's see here. So now we're in 5 years here. If I do nothing for 5 years, I've already made that portion to cover the $155,000 gain. So, okay, 6 years, okay, because I want to make sure I round up. So as long as I hold my property for more than 6 years, I would make more than whatever the penalty is for holding on to that property. Okay, so that's one way to look at it. Now, if you're in, let's say, a province where the appreciation's not there, or if you don't, like if you're not cash flowing, oh my God, right? Then actually, you know what? Then that may not even matter, because you're not going to have capital gains. Like if you're in a province like where, or like during a time frame where there's been no capital gains, like in Toronto and in like Vancouver, there's been times where there's been no capital gains, right? Or like no appreciation for like a chunk of time, like eight years or something. So if you're in a time frame or in a province where there's no appreciation, and so then there's no capital gains, then this calculation doesn't even matter, right? Because you're not paying anything on capital gains, so it doesn't matter. Okay, so so if you're like, well, Huong, how do I know if there's been any sort of appreciation? Just Google, you know, appreciation from when you bought it to what the current market is, and that's how you're going to know if there's been any capital gains on your property. Okay, so okay, so you know what? Since I brought that up, let me just point that out to you. Okay, so let me just show you. Okay, so if you purchased this property, and it doesn't matter when you purchased it, okay, you purchased it and it was, let's just say $400,000, okay, and you held on to it, and it doesn't matter how long you held on to it, okay, meaning that, okay, like it's got to be more than 1 or 2 years, okay, because otherwise then you're triggering some other taxation stuff on like flipping or whatever like that. So let's just say you've held on to it. It's been 5 years, okay? And in that 5 years, it's only gone up to 450,000. Okay? Which actually really sucks, okay? So now this is in today's market, okay? So if you sold it, and let's just say you had like, you know, the cost of selling it, cost to sell, let's just say it was 20,000. So that's your legals, your real estate agent, any sort of renovations that you had to do to get ready to sell it. Okay, you can write that off. Okay, so this is your profit here. So it would be, sorry, so let me increase this so you can see what I'm working on here. Okay, so your profit would be your 450 less your 20,000, less your 400 that you paid in, okay? So this profit is your capital gains, okay? So now this is not the amount that you would put into your taxable line. This is just your capital gains, okay? So if we did the 50%, which is the current inclusion rate, you would be at 330,000 times your 50%. Okay, so this is how much you would put on your taxable line, taxable income. Okay, so then you would be taxed at your margin on this 15,000. Okay, so that's how you calculate your capital gains. So now, if in today's market there's been barely any appreciation, okay, so let's just say in some markets it's barely gone up, okay, you've had zero capital gains. So then on your line, you would just actually put zero. It wouldn't be a negative number, okay, because you're not allowed to have negative capital gains, okay? So now I'm just going to preface that though. I'm not an accountant, so you do need to verify that with your accountant, okay? So, okay, and if you're asking, Hung, where would you see this? In some provinces, some places, there is no appreciation. Okay. And for some flippers, this has been a real big issue because they would buy, they would put in the money to renovate, and then they turn around and they try to sell it and they can't recoup their money. Okay. So this is a realistic, it can be a realistic scenario for some investors, and it's not an ideal situation. Okay. So let's go back into the spreadsheet here now. Okay. So in order for me to keep this property, to make it worthwhile for me to keep this property, if I'm going to see a $1.5 million capital gains in the future, if I can make 15% return on that, I need to hold on to this property for about 6 years. Okay, so now what I found really interesting was as I was doing this analysis, I came up with a few notes that I want to share with you here, because I think that this may also shed some light into this analysis. Okay, so my first thought was, okay, well, if I sell it in the future, okay, then I'm assuming that 1.5 million capital gains is not recognized today, right? It means that I'm going to see that in the future. It means that today it's probably not going to give me a $1.5 million capital gains, right? So that's something that's in the future, and that future could be 5 years, it could be 10 years, it could be whatever time frame, right? Okay, so if that's the case, okay, then this so let's just say I'm using a 15% time horizon here, okay? So that's what this is here. So the increase from the 50% to the 66.67% is a 16.6% gain increase in the capital gains inclusion rate, okay? So if I'm holding it for a 15-year time horizon, that's only a 1.1% increase per year. Okay, so I'm not compounding this increase. Okay, I'm just doing a simple math saying, okay, 16.67 divided by 15 years. Okay, so the longer you hold on to it, the better, because now it's decreasing that increase that the government's trying to propose here. Okay, if I only hold it for, let's say, 4 years, well, then it's a 4%, 4.17% increase on that inclusion rate. Okay, so the time horizon makes a difference here. Okay, so that's the first thing that I realized. And then the second thought that I had was, when you hold on to investment property and you go to refinance it, okay, whether it's in 3 years or 5 years or whatever time frame you do your refinance and you pull out equity, okay, that equity is tax free. Okay, so if the tax margin is 26%, well, that's pre-tax dollars. Like it's post-tax dollars. Like it's not taxed at all, right? So you can go and take that money and do another investment with it. Okay, you can live off that money. Like it's such a huge gain. Okay, so that refinancing, if you sell your property, you can't do that. Okay, so for me, that refinancing and getting that tax-free equity pullout has been part of my strategies in my portfolio to grow my portfolio and to help subsidize our, carefree living. Okay. So now, of course, this tax-free equity pullout does affect, one, your annual appreciation. Are you making a mortgage pay down? Will the bank refinance you? Right? If they don't refinance, there's been no mortgage pay down and no appreciation, well, then there's not going to be any equity pullout. Like there needs to be those components. Okay. And then my third comment was, okay, as long as I can make more than compared to that time horizon that we talked about. Okay. So the third thought I had was, oh my God, I'm so glad that I've set up my infinite banking and my immediate banking concept. Okay, so the IFA and the IBC is a strategy that you can use. Well, it's a strategy, but some people would say it's a product, okay, within real estate. So the IFA and the IBC, that's something that I've implemented in my portfolio to help alleviate, okay, to help deal with the capital gains in the future. It helps alleviate the stress, okay, regardless of whether or not the capital gains is 50% or 66.67%. Okay, so the IFA and the IBC is something that I've implemented to help me with that. The fourth thing is what I mentioned a little bit earlier, is that if your property has no appreciation whatsoever, then this whole capital gains inclusion rate change isn't going to bother you at all, because you're not going to see any capital gains. Okay. Unfortunately, in my case, there is capital gains, and so this calculation is very relevant for me. Okay, so now the fifth thing that I realized, or it's a thought process that I'm going through, and I'm trying to like make sure that I put it out there so that I know to give it enough thought and energy to, is, okay, well, the money today is worth more than it is going to be tomorrow. Okay, like this isn't always the case, but in today's economy, if I sold it today and took out whatever profits that I can make, that money is worth more today than it may be worth in the future. Okay, so that's something that I still need to think about, right? And so then the follow-up thought is, okay, well, wait a minute, if I sell it and cash out now, what am I going to do with that money? Am I just going to sit on it in the bank and make, 2% maybe, put it into a GIC and make 4 or 5%, right? Or do I do some sort of asset class, right? Like, what do I do with it? Right. So, the opportunity cost there. Okay. So, and then of course, my sixth thought process was, okay, why do I care about like why the sixth one was, why do I even care about investing the capital gains money? And that was referring to this calculation over here that I did, where I said, okay, well, how many years do I need to actually still hold on to that property to make it worthwhile over selling it today, right? And so I think I sort of explained that, is because then I know how many years I need to hold on to it at what return, so that I'm breaking even, so it's not costing me any more money, right? Okay. And then the one last thing that I need to do is confirm what the tax rates are for BC, because that's what's really going to hit me. Like, so when I started this calculation, I ran it for Ontario because that's where most of my portfolio is. But then I was like, well, wait a minute, I'm a resident of BC. I'm going to be taxed at BC's rate, not the Toronto stuff, or not Ontario. Okay, so I now need to redo this for BC. Okay, so that is my long 2 cents thought on this capital gains proposal coming up. Now, I'm saying proposal because it's not 100% for sure, but I don't quite understand that either, because it's like, if it's proposed and it's not for sure, then does that mean it can actually be canceled and not actually take into effect, right? But when you read all the websites and stuff, it actually says, that this is happening on June 25th. So, it can be a little bit misleading, but I thought, okay, you know what? If there's even a chance that this will happen, even if this doesn't affect me, I still want to know that it doesn't affect me. And the only way to know that is to go through the math, is to think this through and figure out, okay, well, will this actually affect me or not? Okay, so in my case, it definitely will affect me significantly. And then, so now the question is, well, what am I going to do with it, right? Okay, so I've answered those two things. So let me now go into some of the questions that we got over the last week. And we did have quite a lot of questions, which is really amazing here. So if you have a question, please use the QR code and you can email it to me. Okay. Okay, so let me take this one question. Some of these are actually really amazing questions, and I think what we need to do is actually have a calculation to go with them. So some of these, I think I will actually defer this for another week when I can show a calculation on them. Okay, so I'm going to answer the two. Oh, the three. Okay, so there's three that I can answer without, that it doesn't really matter if I do a math question on it or not. Okay, so the first one I will answer is about renting. Is it better to fill a vacant unit no matter what? For example, so lowering the rents. Okay, so that would definitely be one way, or waiting. Okay, so I can put my comments on that because I still self-manage some of my properties in Toronto, and I've done things in the past to fill it up, like lowering the rent, offering incentives. Okay, and because the thing is that you need to realize that if your unit is sitting vacant, then you're not making money on that unit, but you're still responsible for all the expenses, including the mortgage payments. And so, you don't want to sit on a vacant unit for too long. Okay, but now here is the sort of opposite thought on that, is that it's better to have a vacant unit and to pay those expenses out of your own pocket than to have a bad tenant. Oh my God, because if you have a bad tenant, they don't pay rent or they damage your unit, that is very, very costly. Okay. And then if you are in a place where it's more tenant friendly in terms of the landlord tenant rules, then you could be suffering significantly for 6+ months. Okay. So to answer this, I would say, really take a hard look and say, okay, would you rather a bad tenant in there that doesn't pay rent or damage, and then still having to deal with them for 6 months or potentially longer going through the tribunal board? Okay, because that could really happen. So I've been very, very fortunate that I've had great tenants, right? Partly because I cherry pick them. So I will usually lower the rents. So like if I put a unit out and after like a week or 2 weeks, if I can't rent it out, I will lower the rent, let's say by $100 or a month. Now that adds up over time. Okay. And you can see it significantly more if the tenant stays there longer, like more than 2 years, right? Because now in certain provinces, you can only raise the rent so much year over year. So in Ontario, we've been able to raise the rent like 2%, 1%, like in some years, 0%. So imagine like if you can only raise the rent 2 years and per year and you've lowered the rent to get a good tenant in there, okay, then potentially year over year, you're losing money. So like, for example, I have a unit that I'm renting now below market rent by $500 a month. So I'm losing $500 a month. Okay. Now you need to sort of weigh that and say, well, wait a minute, Huong, you're losing $500 a month. But if you had a crappy tenant who wasn't paying you rent, you'd be out, the $1,500 or the $2,000 anyways. Okay. And plus, with the good tenant in there, even though it's $500 less, you have no headaches from that tenant, right? So you sort of have to weigh the pros and cons on that. Okay. So the one strategy that I would have with offering the incentives or the lower rent is to put it into the lease document to make it so that it doesn't kick in until the end of the lease. So for example, like if you're offering like to have the utilities paid by the landlord, so if you're going to cover like, $20 a month on the utilities, don't make it that you're covering it right now for every single month going forward. It's going to be at the end of the lease, barring no issues, barring all rents paid on time, a reimbursement of $20 a month for utilities will be given. Okay, so you want it so that it's based on them staying for a certain amount of period on good performance, basically. Okay, so that way, if they take off, then you're not like, if they take off before that end of their lease, then one, you don't have to give them that incentive, right? Or if they stop paying rent and damage the place, then you don't need to give them that incentive. Okay, so that's how I would do the renting there. And it actually would be interesting, now I'm thinking about it, that it may be good for me to show a calculation on how much potentially you could be losing if you take a good tenant versus giving, like, take a good tenant but at a lower rent, and then what that actually means in potential lost profit for you. Okay, let me go into the next one about using. Okay, so the next question is around using your RSPs and or TFSAs for investing in real estate. Okay, yes, you can definitely use your RSPs and TFSAs for investing in real estate. Now, this is not the first-time home buyers that we're talking about here. This is tapping into your registered funds to be an investor in real estate, either through a mutual fund trust or to go on different platforms using your RSPs. So yes, you can definitely do that in syndications as well. So syndication, so you take your RSPs or TFSAs and you are a part of a syndication to buy into real estate. So you yourself don't own it. The same thing for a mutual fund trust. You usually are not the one owning it. You would put in the money and then have a group or an individual manage it for you. Okay. The only time where I would say where you would be managing it would be is if you're using your RSPs and your TFSAs for a private lending, usually a second mortgage on a property for another investor. So that's where you're using it to provide them with like a smaller amount. And so usually like RSPs or TFSAs maybe like, 25 to, the highest I've ever seen is like 500,000 to go into a second private mortgage. So there's lots of things that you can do within real estate with your RSPs and TFSAs in real estate. Okay, so you don't physically have to own that property. And if you have money in your RSPs or TFSAs, then yes, you could definitely get into real estate. Okay, there's actually a book out there as well that you could buy, and I can't remember the name of it, but if I find it, I will include it in the screenshot for this this podcast. Okay, so so this question here. Okay, my last question is can you get the same level of appreciation in Alberta as you can in BC and Ontario? Can you get the same level of appreciation? Okay, so I would say that usually we have not seen, okay, based on past history, Alberta has not seen the same level of appreciation as BC and Ontario. Okay. And you can Google this, like there's so many graphs, so many charts. Okay. Now, when things are booming, okay, all those three provinces, you will see an increase in appreciation. Okay. But the level of appreciation has not been the same in those three provinces. Okay. Now, that's with passive appreciation. So passive appreciation is where the property just sits there and you don't really do anything with it. Year over year, it goes up. Okay. Like I think on one of the episodes, I talked about a BC property that increased by $1 million every year just from sitting there. Like it's not like you added another unit or like added like another extension to the building, nothing. It just sat there and it grew by $1 million. Okay. I would say in Alberta, you do not get the same level of passive appreciation as you would in BC or Ontario. Now that, of course, I'm just going to put in a disclaimer there that not all areas in BC and Ontario see the same level of appreciation either. Okay, so keep that in mind that it's very specific for the cities. Okay, now when it comes to forced appreciation, that's a different matter because forced appreciation is where you're adding in additional units, you're adding an extension, you're adding some additional streams of income. Like let's say you're adding, like if you have a multifamily asset class and you're able to convert all of your tenants to paying their own hydro, and you as the landlord aren't paying that anymore, that's a forced appreciation, okay, which is fantastic if you can do that. Or let's just say you have like a bunch of garages and you can somehow divide them and add in additional storage, and then you charge the tenants for that storage. Okay, that's forced appreciation. In those cases, you may be able to get the same level of appreciation across the board because you're forcing it. Okay, but that is very difficult to be able to gauge, right? Yeah. Okay. So the forced appreciation is one way to level the playing field across the different cities in those provinces. But when it comes to passive appreciation, I would say no way. Like you know, the regardless of the entry point to get in or how much further your dollar can go, the appreciation is something completely different. Okay. All right. That is it for today. Thank you for watching, everybody. And if you have any comments, questions, please use the QR code. Okay. Thank you again. See everybody next Monday. Have a great day.